If you've ever looked at a stock like Tesla or Meta and thought, I'd love to sell puts, but I don't think I have enough cash, this video is for you. I'm gonna show you how to use a defined risk strategy trading credit spreads. And I'm not only gonna tell you about it, but I'm gonna show you step by step in my platform. You can literally start trading with less than $1,000. In fact, I'm going to show you a specific trade that only takes $500. And I'm gonna show you how you can use this strategy to literally make yourself about $160 a month. Now stay until the end, because I'm gonna give you my checklist and risk rules so you can copy them when you're trading your own tickers. Now before we jump right in, please do me a favor. Hit the subscribe button in the bottom right. It really helps grow the channel and ultimately let other people find videos like this. So let's jump right in. All right, check it out, guys. So here is a 52-week chart of Tesla. Tesla has been my favorite ticker for years upon years. But guess what? It's $455 a share. And I know a lot of people don't have the capital to trade this kind of a ticker. But here is how you can trade it using credit spreads. So credit spreads is a defined risk strategy, meaning you can only lose a certain amount of money. And I'm going to show you exactly how to calculate that. And you can still take in income by trading the ticker. So let's go through exactly what it means and how to do it. Now, a credit spread means this. Typically, you can sell a put and then you can buy another put for a lower strike price. And the difference between those two strike prices is the maximum loss that you can have in that trade. So no matter what happens, worst case scenario, that's the maximum amount that you can lose. So just as in all the trades, you are the driver of how you want to structure that. So let's go through and talk through a few different options. So here's the options chain for Tesla. So we'll see a few things right off the bat. You see the contract expiration dates, right? So Tesla is very liquidly traded. So it's traded a lot. A lot of people are buying and selling, and also a lot of people are trading the options. Me personally, I like weekly options because of two reasons, and I talk about that often in these videos. Number one, I want to create myself income every single week. And number two, I don't know what's going to happen with the market on a longer term basis. And I don't want my capital at risk for an extended period of time. So we're going to look at right now a December 12th contract. Now strikes are going to be down the middle, right? So when we sell a put, we're committing to buy 100 shares at the strike price, but only if the stock drops below that price before the contract expires. And for that commitment, we're paid a premium. Now a credit spread concerns what we call two legs of the trade. You're selling one put and you're buying a put with a lower strike. And that's what gives you the protection, and that's what makes it a defined risk strategy. Now, when I trade credit spreads, I want the strikes to be kind of far away from where the stock is currently trading. So I always look at the delta. The delta gives you the statistical likelihood that the stock is going to drop to that value before the contract expires. So just as a starting point, we're going to look at a 15 delta, and that is a strike price of $427.50. Now, once again, the stock right now is trading at $4.55 per share, as we can see up here. Now, I'm going to show you how to input the trade on my platform, which is Thinkorswim. So I'm going to right click on the contract, and I'm going to go to sell, and I'm going to go to vertical. And that pulls up an order entry window that has two legs of the trade. And we can change the strike prices. So for example, this is selling one Tesla December 12th, $427.50 put, because that's the contract that I clicked on. But if I wanted to, I can change it right here in this box. And then at the same time, we're buying one Tesla, the same expiration date of December 12th. And then I'm going to change this to $422.50. And here's how you want to look at credit spreads. Your maximum loss is going to be the difference between the strike prices. So in other words, if I'm selling the $427.50 put and I'm buying the $422.50 put, the difference between those two numbers is 5. And because each contract represents 100 shares, what we're going to do is we're going to multiply 5 times 100. And in this scenario here, our maximum loss would be $500. And the price is showing a net credit. So the way that this price is driven, and we can change this in a moment, and I'm going to show you that in a moment, but basically this price is driven by using the mid price between those two contracts. So in other words, let's walk through that to kind of illustrate what I mean. So if we're looking at the short put, the $427.50, it has a bid of $214 and an ask of $218. What that means is this. If I wanted to sell this and I put a limit order in to sell it at $2.14, it would automatically be filled because there are already buyers at that price. When we're putting in a spread order, typically the system is going to use a mid price. So the mid price between 214 and 218 would be 216. Right? Now, if we're looking at the buy contract, the 422.50, that has a bid of 158 and an ask of 161. So that would have a mid price of about 1.6. It won't be exact. So for example, what I would be doing is this. I'm selling the 427.50 at a price of 2.16, and then I'm buying the 422.50 at a price of, let's say, 1.6. So I'm going to do 2.16 minus 1.6. So that gives us our credit here of 56. Here's what that means, guys. Again, because each contract represents 100 shares, we're going to multiply this credit times 100. So $56 would get dropped into our account right when we make the trade. We are selling one 427.50 put and we're buying one underneath, and that's our protection, and that's what makes it a defined risk strategy. The most we can lose on this trade is $500, which is the difference between the two strike prices, and the most we can gain on the trade is $56. Now, how do we calculate what the gain would be on the trade? Well, here's the easiest way to understand that. If Tesla closes on December 12th above 427.50, well, that means both of these contracts will expire worthless, meaning we won't be required to buy the 100 shares at 427.50 because the stock is trading higher than that level. And the put that we purchased, the 422.50 put that we purchased, will also expire worthless because the price of the stock would be trading higher. That means we would keep the entire $56. Now we're going to walk through a couple of scenarios based on what might happen with the price of Tesla. For example, let's say the price of Tesla starts trading at 425. So it's below the price of our short put of 427.50, but it's above the price of our long put of 422.50. In the case of short puts, it's always up to the person who holds the contract to exercise it. In practice, most contracts only get assigned or exercised at the expiration when the market closes on December 12th. But it is possible that if Tesla is trading at $425 per share, that someone assigns the contract early, forcing us to purchase 100 shares at $427.50. Now, if that happens, we have to make sure that we have enough capital in our account to be able to hold those 100 shares, first of all. Second of all, we still have the protective put of 422.50. As with all option contracts, you can liquidate your positions before the expiration of the contract, meaning you could buy back your short put of 427.50, and you can also sell your 422.50 put if you wanted to do that. And one of the reasons that I do use a lower delta, like 15 or perhaps even lower, is because I do want as little chance as possible for the stock to drop to that value before the contract expires. Also, typically what I like to do is, let's say on this example, the maximum credit is $56. Once I see around 80% of that value captured, and the way I calculate it is this, once I see both legs trading around 0.05, I typically liquidate both sides. And I always, best practice, now listen to me clearly on this, this is very important, I always close both legs of the contract before the contract expires on December 12th, regardless of where the stock is trading. The reason for that is because I don't want to wake up Saturday morning and find out one of those legs got assigned without me realizing it. Now, typically, a contract only gets assigned if it's in the money. In other words, let's say it's December 12th and the market's getting ready to close and the stock is trading at $430. Well, technically, that's going to mean that both of our puts will expire worthless because our strike prices are underneath where the stock would be trading at $430. However, it's up to the holder of a contract to manually assign it if they wish. So what could happen is if someone anticipates a significant move overnight, perhaps as an example, they could assign that contract even if the price is trading higher. So I remove that risk completely by liquidating both legs before the contract expires. So that's something super important to keep in mind. So the truth about credit spreads is this. they're a little bit more to manage. There are these multiple pieces and legs of the contract. And so me personally, I don't really trade credit spreads often, although I have in the past. I tend to stick to easier strategies. So for example, if I had a smaller account and I wasn't able to trade Tesla because of the price at 455, me personally, I would trade TSLA, which is a leveraged ETF that moves like Tesla, and I would simply just sell puts on that and covered calls if I was assigned, or I would choose a different ticker that's more appropriate and consistent with the size of my account. But credit spreads are a very useful strategy that you can use for smaller accounts in particular to be able to trade big names that you otherwise wouldn't be able to afford. Now you can also do call credit spreads. So this was an example of a put credit spread, but you can also sell a call credit spread. And let me walk through that with you as well. So Tesla, as I mentioned, is $4.55 per share, and our call option chain is on the left-hand side here. So I'm going to go to a 15 delta as an example, and I'm going to right click on this contract here, this $485 contract. And I'm going to go to sell, and I'm going to go to vertical again. And that pulls up my two-legged trade window in which I am selling a 485 call, and it automatically pulls up purchasing a 487.50 call, but we can change that to 490 because that matches the example I just showed you with a put credit spread. In this case, there's a $5 difference between the two strikes, so there's a $500 maximum loss. And it automatically pulls up the credit for us just like it did in the other example. Now, I didn't show you in the other example, but I'll show you here. We can always change the price of the credit. So typically, if I was trading a credit spread, I might go like 1 penny below the mid price that the system gives me. That doesn't mean it will get filled, but it gives you more of an opportunity. Along those same lines of logic, if I was to, let's say, a limit credit of 50.5 or $50 would get dropped into our account, that would give us an even higher likelihood for the trade to fill. And personally, what I do, and what I would do if I was trading a credit spread, is I would set an alarm on my phone to let me know if and when Tesla trades above $485. That way I can make sure I pay attention to my account and perhaps look to liquidate the trade or make some sort of adjustment as needed. Now, a call credit spread is this, just to walk through the functionality of it. You're selling a 485 call and you're buying a 490 call. So someone would sell a call credit spread if they're somewhat bearish, perhaps neutral or bearish on that particular ticker. Me personally, I wouldn't sell a call credit spread on Tesla because I think Tesla is a very good stock and a very good underlying, and I believe in the price appreciation of Tesla. So if I was to make this trade, I would only trade a put credit spread. You can also trade both sides. So let me show you an example of that. So the 427.50 was our example on the put side. So I'm going to right click and I'm going to go to sell, and then I'm going to go to iron condor, because when you're selling a put credit spread and a call credit spread at the same time, it's called an iron condor, and it pulls up these 4 trades in this one window. So when we take a look at this, we can also again adjust the strike prices, and we can also adjust the credit price. So if I wanted to use 15 delta strikes on both sides, and let's say I wanted to cap the risk at $5 in between each side, I would sell the 427.50 here, and I would buy the 422.50. That's the example that we showed, that we walked through a moment ago. And then on the call side, I would sell the 485 and I would buy the 490. So let's just walk through each of these pieces to make sure we have it correct. So my calls are listed at the top, and Tesla is trading at $4.55 per share. So I'm selling the 485 call and I'm buying the 490 call. That gives us a maximum risk right here of $500. And then at the same time, I'm selling the 427.50 put and I'm buying the 422.50 put. And that also gives us a maximum risk of $500. Now, iron condors are interesting for this sense. The stock price can't close above my call price and at the same time close below my put price. So typically, the way you want to look at this is your maximum risk is not really $1,000. Some people might think it's $1,000 because you're adding 500 to 500, but really your maximum risk is still $500. Because if the price goes up and the call goes in the money, your puts will not be in the money and will expire worthless, and vice versa. Now, the system automatically calculates the mid-price credit of 1.1 meaning that $110 gets dropped into our account right then and there when we make the trade. That's the most amount of money that we can make. And technically, we can lose up to $1,000 because that's the difference on each side, the call side and the put side. However, in effect, our maximum loss is still $500. Now, what you want to be concerned about is this, and this is why credit spreads can be a little bit challenging to manage, is if the price of Tesla moves into either the 485 range on the upside or down to the 427.50 range on the put side, you really want to actively manage this position. So you want to look into perhaps liquidating those legs, or you want to be prepared to perhaps take assignment. And let's walk through how that might look. So we talked a moment ago, for example, on the put credit spread. Let's say the price of Tesla goes to $425 per share. Well, you can be assigned on the 427.50 put, meaning you could be required to purchase 100 shares at that moment in time, and then you can either sell the shares or you can sell a covered call against those shares. And at the same time, you already have the long put, and you can keep the long put as insurance, you might say, or you can liquidate that. Now, logically, if the price of Tesla is going down and you get assigned on the shares, the 427.50 shares, the value of your 422.50 put might be higher because the price of the underlying is going down. So that's actually a good story. On the call side, in my view, it's a little bit more dangerous in the sense that if the price of Tesla starts going higher, and let's say it breaches the 485 level, if you were to get assigned and you don't have the shares to deliver, you would be short 100 shares in your account. And shorting stock is a pretty aggressive strategy because theoretically a stock can go up to infinity. So your risk is unlimited. So that's why personally, I don't like trading on iron condors, but they can deliver a high amount of money, particularly if you're trading a ticker that stays sideways. Because to walk through the best scenario, the best case scenario in this trade, if Tesla trades and then closes by December 12th, in between 427.50 and $485, in that whole range, that means you keep the entire credit and everything will expire worthless. Again, best practice is to liquidate each of the legs, the entire trade, before the contract expires on December 12th. So that's something to keep in mind. Now, you can use a strategy like this on any ticker. In fact, let's walk through META. META is a very expensive ticker as well. It's $673 per share. Let's take a look at the chart, a 52-week chart. This is a very pretty part of the chart where it's a gap. And you'll see META has come down recently pretty significantly. And it's also pretty significantly popped back up again. And typically, the way gaps work in a chart is once it breaches this resistance point here, it will likely keep going and fill this gap back to here. And META, in my view, is overall a very good stock. Now, I'm not here to suggest or recommend any particular trades or any particular stocks. I'm here to educate you and give you trading ideas and the information that you need to do your own due diligence and make your own decisions on your own money. But let's walk through a trade for META. So I'm going to delete this. And again, I'm going to look at a 1-week trade, December 12th. And let's go a little bit more conservative. Let's use a 10 delta in this example. So I would be selling a 640 put. So I'm going to right click and I'm going to go to sell. And I'm going to go to vertical because we're just going to look at a put credit spread first. So again, that's going to pull up my trading window where I'm selling one META December 12th, $640 put. And then I can change this just like before. And let's change this to 635. So in this scenario, it's a $500 maximum loss and it's a $33 credit to our account. Now, if META trades and closes above $640, well, I get to keep that whole $33. Again, I would want to liquidate both legs prior to the expiration. And let's look at a call credit spread as well. Personally, I wouldn't trade a call credit spread on this, especially since the chart points to likely appreciating price. But if we were to do, let's say, an iron condor on this trade, a put credit spread and a call credit spread together, I'm going to right click here. I'm going to click sell. I'm going to go to iron condor. And it's going to pull up my trading window and I can change all of these numbers. So let's walk through it on the put side first. If I was selling a 640 put and then I was buying a 635 put, and then I'm going to go to the 10 delta on the call side, and that would be a 707.50 call. So we want to change this call here, 707.50. And then we are going to be buying $5 more than that. So $712.50 right here. So let's just check our information. So we're using 10 deltas on both the put and the call side. We're selling a 640 put and buying a 635 put. And on the call side, we're selling a 707.50 call and we're buying a 712.50. So we have $5 in between each of these sides, the call side and the put side. And our credit based on the system default would be $65. Now let's give you another example. Let's say if you didn't want to risk $500 per trade, you only want to risk $250 per trade. So what you would do in that case is, if you wanted to still stay with the 10 delta, you would be selling a 640 put and you would be buying a 637.50 put. And if you did the same thing on the call side, you would be selling a 707.50 call and buying a 710 call. And this trade here gives you a default credit price of 43 and a maximum risk of $250 on each side. Because again, you're going to subtract this by this and this by this. So subtract the difference in the strike prices on the call side and subtract the differences in the strike prices on the put side. Does that make sense? Hey guys, so how'd you like that info? I know credit spreads are super confusing. That's why I don't really use them. I prefer, honestly, simple, sell a put, plain vanilla. If the price goes down, I buy it. If the price goes down more, I like the ticker, so I sell another put. And if I have to get assigned, I buy more shares and average my cost down. And when I have shares, I sell a covered call right at my basis at the price at which I own the stock. I'm just looking at collecting money. But a lot of you guys here talk about, different strategies and what if I had smaller accounts, and credit spreads can be very helpful for people with smaller accounts and people who just frankly want to trade expensive tickers, but they don't want to put up the capital or they don't have the capital to put up. Now, I told you at the beginning, I was going to tell you my checklist and risk rules. So check this out. Number one, you want to make sure that you pick the right stock. So typically, especially when you're trading credit spreads, you want to pick a big company that has narrow bid to ask spreads. That way it maximizes the credit when you put your trade in. And you also want to trade something that has a lot of volume and a lot of open interest. So you want to trade a ticker that's very actively traded. So typically you want to look at least 1,000 for volume and at least 1,000 for open interest. That's kind of like a good rule of thumb. You also want to choose a ticker that has a little bit higher implied volatility. Now I showed you Tesla, and Tesla's implied volatility is typically over 50%. That's a good rule of thumb to use. Number two, you want to choose the expiration date, right? So you can choose weekly, 2 weeks, 3 weeks, 4 weeks. Me personally, I like weekly because it puts cash in your pocket every single week and you're not tying up your capital for extended periods of time. Number three, and this is super important, guys, you want to make sure that there's not earnings that's coming up right when you're putting the trade in. Because when there's earnings on a company, it can make that ticker very volatile. And when you're trading a credit spread, you don't want a lot of volatility. You want it to stay in that mid-range. That way you maximize your income. Number four of our checklist and our rules, when you look at which strike to choose, you want to really look at the delta. So the lower the delta, the lower the likelihood the stock is going to reach that price. So a good rule of thumb to start with is a delta between 5 and 15. I wouldn't go higher than 15. You also want to decide the difference between your sell and your buy. So in other words, if you're selling, let's say, $100 put, are you buying the $95 put or are you buying the $97.50 put? You want to decide how much risk you want to have on that part of the trade. Next, you want to check the credit received, and you always want to use a limit order. Never put an order in at the market. Typically, you want to find a credit on a put credit spread or a call credit spread that's at least $30 to $100 to make it worth your risk. Next, position sizing is super important. Listen, most people lose money not because they had bad trades or they were doing necessarily things wrong, but because their position sizes were too big for their account. So typically, if you're trading a credit spread, you want your risk to be no more than, let's say, 10% of your overall account value. That means this. If you start with, let's say, $10,000, you want your maximum risk to be no more than $1,000 per trade. That way you can be wrong a bunch of times and still have money to trade tomorrow. The next important point to keep in mind is you want to set a profit target ahead of time. You want to have a game plan before you enter the trade. So in other words, you want to think about, okay, when I have 80% of my maximum income, I'm going to liquidate this trade and I'm going to move on to the next one. That's a good rule of thumb. And you also, along the same lines, want to set an exit plan. You want to think ahead of time. What happens if one of my legs goes in the money? Do I take assignment on that? You want to consider the size of your account. Do you have enough money to take assignment on that account? So that's super important before you make the trade. And last but not least, no matter where the stock is trading, I always recommend that you liquidate both legs or all legs of your position before the market closes, because you don't want to wake up Saturday morning and realize that someone assigned one of those contracts, even if it wasn't in the money. So that's super important. So that's the video on credit spreads. I hope this helps. If you like this content, smash the like button, share it with a friend. Make sure you're subscribed to the channel. Tomorrow, I'm starting the new format on my live stream. Check it out. 3 p.m. Eastern time. I'm gonna walk through a real $5,000 account, enter real trades, and every time I make an adjustment in the portfolio, I'm gonna go live. Hope to see you there. Happy trading.